Europe is home to some of the richest countries in the world. Germany, France, the Netherlands, Sweden. They have massive welfare systems, high living standards, world-class infrastructure, and universal health care. So here's the big question. If Europe is so rich, why does it feel economically weak in 2026? Why is growth slowing? Why is Germany, the engine of Europe, struggling? Why are energy prices still haunting industries? And why are investors quietly shifting capital to the US and Asia? Today, we're breaking down the uncomfortable truth behind Europe's economic slowdown and what it means for the next decade. Let's be clear, Europe is not poor. The European Union's combined GDP is around $17 trillion. It has global brands BMW, Siemens, LVMH, Airbus, SAP. But here's the problem. Wealth is not the same as growth. Over the last decade, the US has consistently outpaced Europe in GDP growth. Us tech giants dominate global markets. Asia continues expanding rapidly. Meanwhile, Europe's growth has been sluggish. Economic strength isn't just about how rich you are today. It's about how fast you're growing tomorrow. And Europe's growth engine is sputtering. Why? Let's start with the biggest structural issue. Europe is getting old. Fast. The median age in the EU is now over 44 years. Countries like Italy and Germany are even older. Here's why this matters. Fewer young workers entering the workforce. More retirees drawing pensions. Higher healthcare spending and lower productivity growth. When a society ages, consumption slows, innovation slows, and risk-taking decreases. Tax pressure increases. In simple terms, Europe has more people retiring than entering the job market. And this creates a massive economic burden. Compare that with the US, which has stronger immigration and younger demographics, or India with its massive youth population. Europe doesn't have a growth population. It has a maintenance population, and maintenance economies don't grow fast. Now, let us talk about the event that exposed Europe's biggest vulnerability, the Russia-Ukraine war. For decades, Europe relied heavily on Russian natural gas. Germany depended on Russia for over 50% of its gas. Italy and other EU states were also deeply exposed. Cheap Russian gas powered German manufacturing, chemical industries, heavy engineering, and steel production. Then 2022 happened. Sanctions, supply cuts, the Nord Stream shutdown, gas prices exploded, electricity costs surged. And even though prices have stabilized compared to peak levels, the damage was done. Energy-intensive industries began relocating, some to the United States, where energy is cheaper, and some to Asia. This wasn't just a temporary crisis, it was a structural shock. Europe built its industrial model on cheap energy. Now that advantage is gone. If Europe is a car, Germany is the engine. And right now, that engine is stalling. Germany's economic model relied on three pillars: cheap Russian energy, strong exports to China, and high-end manufacturing dominance. All three are under pressure. China's economy is slowing down. Chinese companies are now competing in EVs and manufacturing. Energy costs remain higher than pre-war levels. Global demand is weaker. Germany even entered a technical recession recently. Industrial production has been volatile, and manufacturing numbers have struggled. Business confidence has weakened. Because Germany drives supply chains, exports, investment flows, and the EU's economic momentum. A weak Germany equals a weak Europe. Here's something macro investors are quietly watching: capital flows. Over the past few years, U.S. markets attracted massive investment. The U.S. tech sector exploded, and AI investment is concentrated in America. The dollar remains dominant. Meanwhile, European stock markets have underperformed. Venture capital activity is lower than in the U.S. Tech innovation is less aggressive. Europe produces great companies, but it doesn't produce many trillion-dollar tech giants. Why? Heavy regulation, slower capital markets, a conservative financial culture, and fragmented markets across 27 countries. When investors seek growth, they go where innovation is fastest. Right now, that's mostly the US and parts of Asia. Europe prides itself on regulation, strong consumer protection, strict privacy laws like GDP, our environmental leadership, labor protections. These are strengths socially, but economically, they can slow down agility. Startups in Europe often face more compliance costs, stricter labor rules, and complex cross-border regulations. In contrast, the U.S. offers easier capital access, a larger unified market, and a culture that embraces more risk-taking. Europe chooses stability. America chooses growth, and growth attracts money. Europe is leading the global green transition with massive investments in renewable energy, electric vehicles, and carbon neutrality. Long-term, this could be a huge advantage, but short-term, it adds costs. Carbon pricing, energy transition investments, and industrial adjustments are forcing companies to adapt faster than their global competitors. If done right, Europe becomes the cleantech leader of the world. If done wrong, it becomes less competitive. Another hidden issue is productivity growth. Europe's productivity growth has lagged behind the US. The reasons include less tech dominance, fewer AI leaders, a smaller venture ecosystem, and that aging workforce we talked about. Productivity is the ultimate driver of long-term economic strength. Without productivity growth, wages stagnate, GDPs stagnate, and living standards plateau. Europe maintains its wealth, but it struggles to expand it. Now, here's the nuance. Europe is not collapsing. It remains politically stable, socially secure, financially advanced, and highly educated. But it faces major structural challenges: aging demographics, energy restructuring, slower productivity growth, weak industrial momentum, strong regulation, and geopolitical exposure. Europe isn't poor. It's just no longer the fastest horse in the race. And in the world of global macroeconomics, speed matters. There are two possible futures. Scenario 1: manage stability. Europe accepts lower growth, focuses on welfare and social stability, and becomes a high-income, low-growth region. It would be attractive for its quality of life, but not for explosive returns. Scenario 2: reinvention. In this future, Europe boosts innovation funding, invests heavily in AI, completes its energy independence, encourages skilled immigration, and strengthens its capital markets. If that happens, Europe could surprise the world, but it requires bold policy shifts. So, Europe is rich, but economic strength in 2026 isn't about past wealth. It's about demographics, energy, security, innovation speed, capital flows, and productivity growth. And right now, Europe is at a crossroads. Will it remain comfortable and slow, or reinvent itself for the next economic era? That's the macro question investors are watching, and it might just define the next decade. Thanks for watching. If you found this analysis interesting, make sure to like, subscribe, and hit that notification bell for more deep dives into the global economy. See you next time.